James, what are we talking about today?
We're going to answer some of the climate fund's frequently asked questions.
The fund has had a period of strong performance, and as of the middle of October, it's roughly up around 60%. Have people missed the opportunity to buy in?
Yeah, so we have had a really good run year to date. It has been a couple of tough years before this. And so the market really hasn't done a lot in the climate space, and then we've seen a lot in the last 12 months. We think that we're still pretty early on in this bull market. We're a couple of years into probably a 5-year bull market. So in terms of the market opportunity, we still see it being there. And the other thing just to remember is we are an actively managed fund. So if we see stocks or companies running out of runway for growth, we will sell those stocks and move to something where there is more opportunity ahead. In this case, a lot of the performance of 60% year-to-date returns has been driven by a couple of specific areas. So a lot of our nuclear companies have done really well because nuclear is basically back in vogue. A lot of tech companies are buying nuclear power directly from those power companies, which is pushing up those share prices, pushing up those earnings growth profiles for those companies, as well as obviously there's electrical grid companies that go with that. So there's a mad scramble to update the grid, improve the grid, improve the reliability of the grid, and also connect all these renewables to the grid. And so that's leading to a lot of earnings upgrades in that space as well. Interestingly, we're not actually taking profits in either of these two areas yet because we still see these areas as having a lot further to go. If you think about it, nuclear is only becoming more valuable. And so we think we're still early on in the nuclear bull market or renaissance. And on the electrical side, the grid is so old and so unreliable that it's going to take years and years and years for these companies to be able to basically meet this demand. So therefore the earnings growth or the outsized earnings growth is going to go on for many years to come. So we still haven't taken any profits, but again, we're an actively managed fund. So if we do see those stocks move up considerably more, we can take profits and move to some of those areas that are out of favour at the moment. And the good thing about climate is there's plenty of areas to invest in. And so a lot of those renewables have been under pressure for the last couple of years because interest rates have been high. That's particularly hurting those companies. And so a lot of those stocks have basically done nothing for a couple of years now. And so we still see plenty of opportunity to actively manage this fund to generate good returns for clients.
Climate change objectives are for 2050. Does that mean if these targets are met by 2050 that this fund would cease to exist or it would wind up?
Yeah, unfortunately, I don't think we're going to get there by 2050 anyway in developed markets. But the other thing just to point out is a lot of the emerging markets either don't have net zero targets yet or they're well beyond 2050. So for example, China's 2060, India's 2060 as well. But even in developed markets, we're probably not going to get there by 2050. There's just too many industries that are hard to decarbonise. So think about heavy transportation, aviation, cement, steel, things like that, harder to abate industries. We think are going to be well beyond sort of 2050. So unfortunately, we don't even see us getting there by 2050 in developed markets. The other thing just to point out is just because you replace a piece of kit today doesn't mean you're not going to have to replace it again in the future or get it serviced over time. So if you think about, say, a coal plant being shut down today and being replaced with a wind turbine, for example, yes, maybe that turbine's going in new today, but that turbine's probably only going to last 25 to 30 years and then you need to replace it with a new piece of kit. So you can have another opportunity to make a sale if you're a wind turbine company, but also over that life of that asset, you're also going to need to service that asset, provide spare parts to that asset. So I think the best analogy is if you go and buy a piece of air conditioning for your house or a heater for your house today, you're going to pay the company today some money, but you're going to pay that company multiple times over multiple years. As you probably know, as a homeowner, you're going to need to replace that piece of equipment or you're going to need to get spare parts put in or someone come and service it. So I think that's the best analogy. It's exactly the same in this energy transition, we think. So definitely still plenty of opportunity for the fund well beyond 2050.
Nuclear energy sits within our clean energy sub-area of interest. What other energy forms are classified as clean energy?
Yeah, so we get asked a lot about gas, hydro, lithium, things like that. So gas for us is a no, because it's a fossil fuel. There are ways of carbon capture off the gas, but it's very hard to do, uneconomic, so we exclude gas. Lithium, does sit into sort of batteries or does feed into batteries, and batteries are a key part of clean energy because you need to basically store the power of the sun or the wind when the sun's not shining, the wind's not blowing. So batteries, we get that question a lot, and that is a key part of clean energy. Hydro, is clean energy, but obviously if you need to build a new dam, that's not great for the environment. That fits in there as well. But the most obvious ones are just, alongside nuclear, are just wind and solar, and then batteries to back that up as well. And so that's a big focus of our fund, those sort of key renewable areas. And then beyond that, you've got a couple of smaller niche areas. You've got biofuels, things like that. And then you've got hydrogen as well. We don't invest that in there today in meaningful size, but yeah, it's really those renewables today, plus the nuclear.
Why does the climate portfolio have a worse ESG rating than the other portfolios within the Munro strategies?
Yep.
But yet it's a climate/decarbonisation fund.
Yeah. So the the Munro funds more broadly, they tend to invest in a lot of big tech companies, healthcare companies, etc. Those companies have net zero targets. They have good ESG scores. The climate fund is a little bit different in that there's a couple of companies that really skew those scores or those carbon metrics, because a lot of the companies that we're investing in actually create power or create insulation, or they're industrial companies that build something and then therefore they take energy or they produce carbon. So if you take the example of a utility, they might have 90% of their portfolio invested or generating power from wind and solar, but the remaining generation may come from still coal and gas that actually can't be shut down yet. A lot of it's regulated and they're not actually allowed by the companies by the countries that they operate in to actually shut those plants yet, because it's still critical baseload power for the economy. And so that's why you sort of get that skew within the climate fund. In all cases in our fund, those companies are moving away from those fossil fuels and towards renewables, or else we wouldn't be supporting those investments because they're not aligned to sort of our goals of net zero. But in some cases, they still have to run those assets today. The other example I just obviously talked about was like insulation, for example. Insulation is really important for the energy efficiency of buildings. Buildings are 30% of emissions, according to most sources around that. And so it helps obviously with that energy efficiency piece, but those insulation companies obviously produce or use chemicals to produce that insulation. So again, they are part of the emission source, but the improvements are significantly greater in terms of energy efficiency than their actual carbon footprint themselves. I'd also use the example of the waste companies. You know, they have diesel-powered trucks that they go and pick up waste with. They run incinerators, that's hugely energy intensive. They run recycling centres, that's again energy intensive, water intensive and whatnot. But the benefit that they offer on the back end is significantly greater. And at the end of the day, they just pick up other people's trash. So although their carbon footprints are quite high, they're actually dealing with society's problems more broadly.
It appears some areas of climate are becoming a little more correlated to AI. What's driving this, and will it continue through the medium to long term?
Yeah, it's a good question. So at the moment, the sort of phenomenon what we're seeing is a lot of power demand is coming back, particularly in the US. There's a couple of big thematics here. So there's a lot of reshoring going on in the US, like reindustrialization after many years of outsourcing to China. You have obviously electrification, so you got EVs, and also you got buildings like this one becoming more electrified. So think about the gas boiler, now a heat pump, so electrified. And then the last one is probably the other big piece of that sort of power demand coming back in the US after being flat for many years is actually the data center. So data centers are hugely energy intensive. Their carbon footprint's actually bigger globally now than the aviation sector, but it's growing at like 20% per annum. So it's becoming a bigger and bigger problem. And so the reason that some of these stocks are starting to do really, really well, and some of these companies are starting to do really, really well, is because a lot of the order growth for the electrical equipment, the power that they produce, the HVAC that they produce, the insulation that they produce, even their labour in the cases of those that are involved in installing a lot of this equipment, is getting driven by these capex numbers that the hyperscalers are putting out, so the data centre companies. So they're spending more and more money to basically keep up with their peers in AI and drive AI, which means more money into the data centre, which means more orders for these companies. And so that's why there's a sort of emerging link between some of these stocks with big tech. Does that continue long term? Yes, we do think it does, because we see data centre growth continuing for a long period of time. So we think that that's going to be a support to the backlog for a lot of these companies for a long period of time to come.
Do you have a view on high-powered batteries supporting climate and the clean transport area of interest? And can Munro invest into underlying commodities?
Yes, on the second part of the question, we can invest in commodities. We tend to do less of that at Munro. Like if you think about it, you can't pick up the phone and ask Uranium Corp or Lithium Corp or whatever. You can't ask the CFO, how they're feeling about their business. It's a commodity, right? It goes up and down with the commodity. A lot of these stocks and a lot of these earnings for these companies is basically fundamentally tied to the commodity itself. So we tend to have less of a read on those companies. They're not as stable. Whereas if you think about picking up the phone to a HVAC company or a waste company, we tend to invest in the leaders in each of those industries. So that company has a very strong read on what's happening in their end market, what's happening with their customers, what's happening with their backlogs, and also have a very strong industry position relative to peers. So we can speak to the CFO, CEO, or whoever it might be about the outlook for that company and get a really strong sense of what we think the earnings growth profile for the company will be. And therefore it just gives us a lot more comfort to invest in those sort of industrial sort of stocks as opposed to the commodities themselves.
Munro's other strategies have exposure to climate through the climate area of interest. Why would somebody invest in a standalone climate fund if they can get exposure through Munro's other strategies?
Yeah, so some people like this fund because they philosophically believe in climate change and I suppose trying to do something about climate change. So that's great if people want to invest for that reason. But we actually think this fund is going to generate really good returns for investors, and it's simply because the opportunity is so big. It's so vast. It's going to go on for so many different years. So if you think about it just top down, high level, it's going to take a long time and it's a huge opportunity to decarbonise all of these industries out here. So think about all the cars out there on the road, all the trucks out there on the road, all the planes up there in the sky, all the shipping down at the port. It's going to take forever to replace all of this kit. And so that's a huge opportunity for the companies that are involved in doing that. If you think about the power generation, the electrical grid, it's going to take a long time to build these grids or to strengthen these grids because they're just so old. It's going to take a long time to shut down all this coal and gas and replace it with all these renewables. Think about the waste opportunity, think about all the plastic out there, think about all the recycling. Huge problem, but also a huge opportunity on the side. And we think we own the companies that can help with that. Think about like land, water, these are all big like emerging issues, cleaning up all of these issues. And think about all the companies involved there. So, we think there's a lot of emerging sort of champions coming out of this area, and therefore the opportunity is really huge. And we obviously intend to hopefully buy all these emerging champions within this fund. And we think that's going to drive the earnings growth of the fund, and it'll drive the subsequent performance of the fund as well in terms of the stocks.
We've covered a lot of different topics. To summarise, can you just recap the main thematics within the climate fund?
Yeah, so the climate fund is really, the earnings growth from the climate fund is really coming from this net zero spending of companies, even investors like us pushing companies to invest more into decarbonisation of their operations and so forth. And so it's a huge opportunity. It's going to be at least a 30-year opportunity. It's going to cost at least $50 trillion to decarbonise the planet per a lot of these investment bank estimates. So it's a huge opportunity. And then it's going to touch many different parts of the economy as well, multiple sectors. It's going to touch all industrial sectors really. It's going to touch all transport sectors, utilities, commodities. So it's a very, very vast opportunity. There's lots of different things to invest into. Really we're trying to distill it into 4 sort of key areas or key sub areas when we think about it. So we're thinking about clean transport. So decarbonisation of cars out on the road, changing your traditional ICE car with the EV over time. We're thinking about a circular economy, so reusing commodities better today, so recycling waste, water, land, etc. Issues there. Energy efficiency, so decarbonisation of buildings, really. So that's a lot of HVAC companies, insulation companies, electrical companies, lighting companies. So very diverse opportunity set there. And then the last one is clean energy, which I think is the one that most people think about. It's shutting coal and gas and replacing it with renewables, basically. So those are sort of the 4 sub areas, but it's hugely fragmented below that, and sort of thinking about all the different opportunities to invest into. But that's sort of the 50,000 foot view of what we're trying to do here with this fund.